Okay, I think we're ready. So good morning, everyone, and welcome to this Q&A session with Noreco Management. My name is Theodor Sveen Nilsen, and I'm E&P analyst at SpareBank 1 Markets. Today's session will be hosted by XtraInvestor in collaboration with SpareBank 1 Markets. Today's participants will be Noreco CEO David Cook and also Noreco CFO Euan Shirley, and also myself. The structure today will first be a short presentation by David and Euan, and then we will move over to the Q&A session based on the pre-submitted questions that we have received, and we received a lot of relevant and interesting questions also, so thank you for that. We'll try to keep this session no longer than 45 minutes unless we get a lot of questions coming in during the Q&A session. So by that short introduction, I'll give the word to you, David, and Euan for our short company presentation.
Thank you very much, Theodor. It's great to be here with yourself and with XtraInvestor. And we certainly look forward to sharing our own enthusiasm and hopefully a few insights into Noreco as we go through these next 45 minutes or so. I think it's important to note, as part of what Noreco will be, we really want everyone out there to be part of our journey. I think you're going to find us to be a company that's going to be transparent and approachable, and also eager to listen to whatever you or any one of our investors have to say. But with that, let me go to our presentation and see if we can get ourselves set up. So when we talk about Noreco, and please note that all this presentation will be posted to our Noreco website after this is done, so the slides will be available to everyone afterwards. But we are a transformed North Sea oil and gas company. After the successful acquisition of around 37% of the Danish Underground Consortium, we have become the second largest producer in Denmark, currently with around 30,000 barrels of oil equivalent a day, and with a clear visibility towards over 50,000 barrels a day upon the Tyra completion. Perhaps most importantly, and part of the story you'll hear today, is we sit on top of over 400 million barrels of 2P and contingent resources. This creates a tremendous opportunity for us going forward. And in particular, we have a lot of opportunities sitting right within the DUC. And I'll describe those further, but these, as I'll call them, barrels in our own backyard, can be some of the most capitally efficient, operationally low-cost barrels that we can add into the portfolio. We've been able to really manage the risk associated with this acquisition, both from an operational as well as from a financial perspective. And our knowledge of the subsurface, our understanding of the reservoirs, the production and infrastructure in place, as well as the commercial structure giving us the volume guarantee and the price hedging we've put in place, gives us tremendous cash flow visibility. All that really leads to a very predictable, in fact, it's been called to my face, boring in a positive way, performance. And you'll see us consistently in line with our quarterly guidance. And we'll continue to see this sort of stable performance up through the Tyra redevelopment when we really change our baseline. All this is enabled and sits on top of a rather conservative capital structure. We've got a diversified source of funding, set of sources of funding. And most importantly, perhaps, we have no debt maturities or capital repayments that occur until after the completion of the Tyra project. When you look at what our production profile looks like, we have the sanctioned production, which really means the Tyra project, driving us up by 70% over the next couple of years. And yet after that, we also have further mature projects, as I've mentioned. And those projects are going to give us an even longer wavelength of stable production, if you will. The addition of Tyra will add more gas into our production mix, but most importantly, will also create additional cash flow to support our ongoing and future investments that sit out there. As I noted, we have a number of these mature projects sitting right inside the DUC, the barrels in our own backyard. These are low risk, capitally efficient, and ultimately will utilize existing infrastructure and ultimately help to keep our post-Tyra operating costs down while our production goes up. Just to give you a sense of what that looks like, there's already visible in our hopper of investment opportunities, sort of 10 projects that could add beyond Tyra another 70 million barrels of resource at circa $10 per barrel development costs. So this, there's a really significant opportunity if these become our best and top ranked opportunities for investment going forward. Of course, Tyra is core to the immediate growth story, if you will. It's significant not only to Noreco, but to the DUC and to Denmark. Tyra is a tribute, if you will, to the DUC and to the reservoirs that we are producing from. Having already produced for over 35 years and almost 90% of Denmark's gas, we, with the completion of the redevelopment project, will extend that by another 20 plus years. That modernization of the infrastructure will enable that future production while reducing the carbon emissions and reducing our operating costs and providing safe, solid infrastructure for incremental project tie-ins and opportunities. It ultimately will add over 70 million barrels of oil equivalent net to Noreco and around 60,000 barrels equivalent a day to the DUC, or 20,000 net to Noreco of production after restart and ramp up. Perhaps importantly, again, this is a very capital efficient project, especially given the scale that's there. Of course, a lot of the questions that come out are around what Tyra and when Tyra will be delivered and what it will look like. Important, we just took FID or sanction of this in 2017. We laid out a project plan and have set out milestones for 2019 and 2020, and those have all actually been achieved as per plan. As recently as yesterday, quite honestly, the picture that you see to the right is actually a rather stunning morning shot of the installation of our 2 new jackets in the Tyra field that was just completed yesterday morning. So a safe and successful installation campaign there. Going forward, we have new milestones to look forward to in 2021, which really involves the sail away of topsides and wellhead recovery platforms. Those ultimately will sail away and then look to installation on those in 2021 and 2022. Of course, COVID-19 was not part of our plan, nor was it part of anyone's plan. This has affected everyone's lives and certainly changed the way things work. However, the first focus that our operator and ourselves took obviously was for the health and safety of everyone in our company, in our communities, and in the yards as well. And so it has indeed impacted those. However, the delivery that we've shown already per schedule is a testimony to the real focus and ability of our operator to get these things done. There was contingency sitting inside the project schedule, and that contingency has been impacted by COVID. We're now just in a process of making sure that we understand and mitigate the risks created by the loss of that contingency in order to preserve the cost and schedule of the project going forward. I think with that, we're going to shift over and do a light touch on some of the financials with Ewan, and then we'll come back and start getting ready for the Q&A.
Thank you, David. So yeah, absolutely. Very happy to be presenting today and look forward to walking you through in a high level our financial structure. As David mentioned, one of the key aspects of the company has been the acquisition of the Shell's interest in the Danish Underground Consortium. And as part of that transaction, fundamentally what the company did was put in place, starting from the bottom up, a firm and robust financial structure to support the operations of the company. So starting from the acquisition itself, we put in place a set of capital, both equity and debt, to fund the transaction. And in order to do that, we raised over $1.4 billion in proceeds, roughly 400 million of equity, a convertible bond, and also, importantly, a reserve-based lending facility of $900 million. To further supplement our capital position, we raised a senior unsecured bond in December 29 of $175 million. On top of that, in order to further mitigate the risk associated with being an oil and gas company, we have significant hedging arrangements in place. When we agreed the acquisition with Shell, Shell guaranteed a minimum level of liquids production until the end of 2020, and we are benefiting from that to the tune of roughly $25 million per quarter. That runs until the end of 2020. And one of the other things that guaranteed level of liquids production enabled us to do was put in place for the period when that arrangement is running a higher level of price hedging than you would otherwise seek to achieve. And what that has meant is that roughly 80% of our guaranteed liquids volumes have been hedged at prices above $70 a barrel until the end of Q3 2020. And subsequent to the transaction closing, we also put in place additional volumes for 2021 and 2022 at roughly $56 a barrel. What this has enabled us to do is throughout the 2020 period, when there has been significant volatility in the commodity price markets, has been to deliver both predictable and stable operational performance, but also do so in a way that has demonstrated significant profitability. So both revenue and adjusted EBITDA of over $400 million and operating cash flow of $337 million is fundamentally in line with our 2020 expectations, given the significant risk mitigation in place that we have, and also the fact that we have limited exposure to, certainly during 2020, the spot commodity prices. Another important part of our financial structure is the tax losses that we have. So we have a substantial Danish tax position, which ultimately impacts our bottom line, with over $1.5 billion of Danish tax losses that will significantly reduce the tax charge that we expect to pay throughout the life of the DUC assets. And as we look forward, we continue through 2020 and into 21 and 22 in a strong position with liquidity of over $227 million of cash at the end of Q2 and an undrawn RBL component of $49 million. As David mentioned, but just to reiterate, we have no debt maturities or capital repayments until Tyra is on stream in 2022. And if we can move on to slide 9. Thank you. The intention of this slide, and I appreciate if people are looking at it on live, it may be quite difficult to read. So I'm not going to go through it in a lot of detail here, but this will be, as David mentioned, available on our website. But the intention was to provide some insight into more of perhaps the Noreco specific elements of our reporting and ultimately our financial performance. I would certainly urge, if there are any specific questions, for you to reach out either as part of this presentation or to me separately, and we can do our best to provide the information that will be helpful in terms of understanding some of the specific idiosyncrasies around the Noreco structure. But just to run through some of the high level points, I think, our revenue, as I've mentioned, incorporates the value of the hedges that we have in place. So that supports a stable revenue line that is relatively predictable, given a substantial portion of the price is known for our hedging. Our operating costs are, I think, for people who are familiar with E&Ps, related to the cost of lifting the barrels that we sell. To the extent that we have over or underlift periods or over or underlift positions during the period, they are also recognized within OPEX. Our EBITDA that we report on our financial statements does not include the contribution from the Shell volume guarantee. So as a consequence of that, we report EBITDA in the P&L, but we also have an additional performance measure, which is adjusted EBITDA, which does include that guaranteed level of liquids production. And then as we move through the financial statements into the non-operating elements, from a finance perspective, there is obviously the interest cost associated with the debt instruments that we have. But one of the other important points to note is that within our structure, we also have a significant portion of hedging. And to the extent that there are hedges that are deemed inefficient, which is an accounting definition, and not linked to physical barrels that were actually lifted, the change in the value of that portfolio, and also the recognition when we realize that contribution comes through our net financial items line, which is why you can sometimes see some relatively large swings in that area, particularly when there's a volatile commodity price market. On the tax line, as I mentioned on the previous page, we recognized our tax losses, which on an absolute basis are roughly $1.5 billion. But on an absolute basis, we recognize the value of those tax losses based on our expected future tax charge when we closed the acquisition in Q3 2019. If you can see it on the far right-hand side in the 2019 column, you can see $400 million in a very small and shaded number. But fundamentally, as we go forward, when we generate what would otherwise have been taxable income that we would have to pay tax on a cash basis on, the taxable charge will still appear in our P&L, but it will be offset by a change in our deferred tax asset rather than, as you would normally expect, being offset by a cash payment. And then finally, we've referenced the other comprehensive income line here. And the reason for doing that was just specifically to note that because we have adopted hedge accounting, the change in value for our efficient hedge portfolio, which is associated with our lifted barrels, that flows through other comprehensive income rather than impacting our net result. And the objective of that is obviously to limit the extent to which commodity price volatility impacts our period by period financial performance. So that was a very quick run through, and I appreciate there's a lot of detail there that we don't have enough time to go into now. But as I said previously, very happy to be open and communicative. And if there are any specific questions, welcome the opportunity to give people a superior understanding of our financial performance going forward. And with that, I'll hand back over to you, David.
Thanks, Ewan. Appreciate that. We'll kind of bring this part to a bit of a wrap and get into some of the Q&A that's out there. But nonetheless, summarizing this, all the things we've said, a huge resource and reserve base, significant reserve replacement ratio in 2019. I raise that again, even though it's almost a year old, in the sense that has primarily been just through optimizations inside of our portfolio. That really means we've added reserves at extremely low cost, therefore high value to the portfolio as well. That all underpins not only existing substantial production, but the Tyra opportunity that's coming, and then with the strong operational cash flow, the access to the additional projects that we see inside the portfolio. All of this coming from a set of reservoirs with extremely low decline rates and of strong understanding due to the length of operation inside of the field. This gives us tremendous opportunity to invest not only in Tyra, but going beyond. We have made our milestones in the Tyra project. I think that's an important point to make. And our focus is doing everything we can to mitigate the risks and make sure that those continue to be delivered upon going forward. We do have, and I've talked about the growth opportunities that sit inside of the DUC, obviously our tax balance inside of Denmark, as well as some tax balances that we have sitting inside the UK, could potentially support additional inorganic value-adding growth as well. All this has been put together through a strong commercial and financial structure with our hedges, with our production volume guarantees, and that really carries out for the next 2 years, which gives us a very visible cash flow profile heading out. And as Ewan has pointed out here very clearly, we have a very aligned financing structure that underpins our investments and our investment timing. So with that, I think we'll close the presentation. Theodore, we'll sort of hand back to you. And
Thank you for that introduction. So of course we have received a lot of very good questions here. So thank you to all that have contributed to that. So first question is around financing, and given the outstanding NOR 14 with a 9% coupon being relatively high, are there any opportunities to refinance this bond with a lower interest rate? Or considering your solid cash position, buybacks of parts of the bond at a lower cost?
So I'll take that one. So I think when we look at the current business today, I think one of the things to set as context, and then it's important to bear in mind, is that we are currently going through the Tyra redevelopment project. And it's important from our perspective to recognize that we take risk mitigation seriously. And in order to ensure that we have a supportive financial base, the key objective for us is making sure that we have a financial position that enables us to deliver the project. And ensuring that we have that strength and flexibility may mean that from an outside-in perspective, it looks like that we're carrying a relatively high cash balance. But I think what it is important to recognize is that that is part of ensuring that we have the ability to deliver on that project in particular. It's also something that when we look at the various opportunities that we assess on a day-to-day basis, we want to ensure that we have the optionality, if we identify things that are sufficiently attractive, that we have the flexibility to invest. That may be opportunities within the DUC that we think are attractive, or also outside of the DUC. And to go back to the question specifically, when we think about the potential to refinance North 14, or to think about potentially buying back, I think there's a couple of relevant points to bear in mind. One is that once Tyra is on stream, the credit profile of our business changes significantly. And I think it wouldn't be unreasonable to highlight the fact that beyond Tyra being on stream, that certainly provides an opportunity for us to look to a potential refinancing to achieve some of the objectives that the question alluded to, such as reducing margin. But the reality of where we sit today as a business is that there is a balance. We want to ensure that we minimize our finance costs, but we also want to ensure that we have the financial flexibility that we need. And I think it's also important to bear in mind that, given where NOR 14, the unsecured bond, is now trading much closer to par than the levels that it was in April, there is much less of an opportunity to achieve a short-term value uplift than there was previously. And I think, to summarize, we think the business has a strong financial base, and we don't want to try and take advantage of any short-term value arbitrage opportunities that ultimately is detrimental to making sure that we have the flexibility that we need.
Okay, thank you. So that's clear. Also, just from my point of view as an analyst, it looks like also other E&P companies are taking the advantage of as the market is open right now to have a strong cash balance. And then this is from my point of view as an analyst, that's important as long as the sector is still very cyclical. So yeah. Okay, so over to the next question, and that's around some insider trading. So CEO David Cook bought on 1st of September shares at an average price of 144 kroner with additional rights to buy 300,000 shares. Could you consider launching a share buyback? And second question, what's the strike of those 300,000 additional shares you have the right to acquire, David? And number three, and also it's only two questions there, yeah.
The simple answer to the first part, or the second part, is the strike price is at 160 krone per share. So that's without there. Ewan, do you want to outline the share buyback?
Yeah, absolutely. So I think we announced a share buyback earlier this year, which was something that in order to achieve, we had to, we received a waiver from our RBL banks, and it was something that was specifically allowed within the terms of our high yield bond. Going forward, there are restrictions on the extent to which we can distribute capital to shareholders until the Tyra project is on stream. And I think it's fair to be candid and say, that restricts our ability or limits our ability to launch a share buyback until Tyra is on stream. So, even though we may see significant value in the share and see a relevance for buying back, it's not something that we're in a position to do at the moment.
Hmm. And just to put this from my perspective, just to put also 144 and 160 into perspective, I think right now we have a 220 kroner target price on the share, and that doesn't assign too much value to 2T resources.
So
all right, thank you. Next question. Say again, please.
Obviously, I need to go buy more. Thanks, Theodore.
Yeah, why not? Yeah, of course. Okay, next question is around UK tax pool. What are your plans to take advantage of the UK tax pool? What's the theoretical value per share? Yes.
I think the tax pools that we've talked about, they are part of our distinctive position, if you will. Perhaps more so inside Denmark. Let's not forget the sort of 1.5 billion that Ewan mentioned in the tax pool available inside of Denmark, which makes that equally an interesting inorganic opportunity for, as well as the organic that we have inside the DUC. In the UK, I think rather than talking about a value per share, it's really about what opportunities, what inorganic opportunities does that open up for us when we can take and apply those tax shares that would make us a more natural owner. And therefore, when we are thinking about future investments and we're looking at our sort of opportunity hopper and ranking things between what we have inside DUC and what we have outside of the DUC, those tax pools clearly put our focus inside of the UK or in an expanded Danish position. I think that's the way to look at how we would be trying to utilize those and leverage those in the near to medium term.
Okay, thank you. And there's one more question here regarding buybacks and buybacks of bond. And it specifically says, when you raised the bond, the purpose was to buy back shares, something you did, and to, after a period, invest in new projects in the DUC. And at the recent conference, your chairman noted that you currently didn't find any attractive investment opportunities. So the question is, if you are not spending cash to buy back outstanding bonds, what's the future plans for this cash balance?
So I'll clarify a little bit, I think, where Rialf is coming from in that certainly our first focus is on assuring and delivering Tyra and our obligations associated with Tyra and our other activities inside of the DUC. Beyond that, we are looking for the next set of value accretive and additive investments, if you will. So I won't say that there aren't attractive investments that are out there. It's really about us taking a look at what we have inside the DUC, what we have inside broader Denmark, what we have inside the UK or the North Sea more broadly, and really ranking those in terms of a next investment hopper while not undermining the risk mitigations we have in place around the project delivery. You know, ultimately, we want to drive this to a place where we do have that sort of pearl necklace of opportunities that we're developing and increasing value along the way, and also be able to return additional capital to shareholders. So I think when you think about the long-term view and what we're trying to do with those investments, we will make additional investments. There are opportunities. We just want to make sure that we're the best logical owner to those so that we extract more value than anyone else.
Makes sense, makes sense. And next question goes to, that's actually probably a question that we could have a separate webinar on. This is on green transition. So a main topic these days are the green transition from oil and gas to renewables. What are your thoughts around the ongoing energy transition? Do you consider opportunities to invest in renewables?
So what are our thoughts around the energy transition? I think we, like everyone, and personally support whatever we can be doing to create that energy transition. Many of us have kids, many of us have a future that we're very interested in, and the actions we take now are the important things that we do to help preserve and improve that future, if you will. I don't see Noreco starting to go out and investing in wind turbines, to be straight, right? I don't see us buying into solar fields. What I do see us doing is thinking very hard about what we can do to make an impact to reduce our carbon footprint in anything inside of our activities. Certainly our portfolio is getting weighted more towards gas with Tyra. That's significantly reducing our carbon emissions at that point in time. We are looking at projects that further enhance or optimize the carbon footprint, such as electrification inside the DUC. And quite honestly, we as Noreco will be looking at not only what we have inside our immediate operations, but what are the things that we could do beyond just that, where we can actually punch above our weight by perhaps being supportive of elements in the energy transition that could go beyond just electrification, but towards things like carbon capture and storage, utilization of our fields infrastructure to support things like that. So it will be a focus. It won't just be words. We're not going to just say ESG. We will put actions behind energy transition and our contribution towards it, but don't expect us to buy wind turbines.
Thank you, that's clear. And just let me add on that, of course, we'll cover around 20 oil and gas companies here as part of one markets, and I think it's very, very good to see some of them are, and of course you include, are very clear on we won't invest in windmills or solar, while some other they have a clear strategy of actually we will invest to achieve A, B, and C, and at least from my point of view as an analyst, it's very good to have a clear answer on that one, as you definitely have.
Sorry, just to add quickly, because you mentioned that. When we talk about electrification in the DUC, obviously that electrification, we would be focused on delivering that through wind generating power. So again, it's a contribution, it's looking through that whole value chain and where we can be part of that, as opposed to, we're just not the right ones. We don't have the capital structure nor the expertise, if you will, to become turbine experts. We'll leave that to the Ørsteds of the world.
And of course, also seen from an investor point of view, it's also could be challenging if you have a company with one cash flow that is from oil and gas, with like some characteristics of volatility, and another type of cash flow that comes from renewable energy sources with probably low return, lower risk, and lower cash flow volatility. So how should you think around this investment case? So that's maybe another challenge of if you mix these two kind of cash flows. But okay, let's leave it by that. Next question, that's regarding the Tyra redevelopment. Should we worry about Total's abilities, and what's the main risks related to the project?
Should we worry? If anybody needs to worry about Total's abilities, that would be us, I think. And quite honestly, if we look at what has been delivered in 2019 and 2020, and if we look at the response that they as an operator have taken to COVID and what we've done both in offshore work as well as in the yards, I'd have to say it's been top class, quite honestly. That being said, we are not sitting back as an inactive observer. We are very much involved in looking at what's coming and ahead. We do understand that we have lost some of the contingency that we had inside the plans. We will be involved in the cost schedule and risk analyses that go forward and putting together new schedules. We will put capability in, and that for me is the assurance that we won't have to worry about Total's abilities, because we'll have that good insight through a collaborative and cooperative approach with our operator. So no, not worried about their abilities. I don't consider them a risk to the project. You know, the biggest risk has been what we are going through right now with the pandemic. And as I've said, you know, the response by the operator ourselves to try to mitigate the impact inside of the yards are probably the hardest thing to manage for us. That being said, we are constantly undergoing these activities. We do have literally within less than a month and a half another big look at the overall schedule and what mitigations, if any, need to be put in place to make sure that we deliver that. So we get our sail-aways in 2021, and then we're able to do the installations in 21 and 22.
So could I just, this is not part of the submitted question, but I'm just curious, how has the virus situation given any delays at all? Could you comment around that when it comes to the Tyra redevelopment?
Sure, I can be very explicit. You know, in our yards, ranging from Batam to Singapore to Italy, everyone was impacted by this. And what that really meant was a necessary demanning of those yards. In other words, the available skill was just not able to participate for a period of time. And obviously it's the man hours that then support the delivery of the schedule and the welds and everything that has to be done. And when you demand, that gets impacted. So that's what we've been looking at. But as I said, we've had contingency in the project. You always do major projects, and I've done a lot of major projects in places around the world. Major projects always have this contingency. There's always risk to schedule. Sometimes you find opportunities to accelerate. As you go further through the project, you find ways that you can deliver efficiencies, either in the fabrication in the yards or in the transportation or in hookup and installation. Those are all the things that we need to be looking at right now to help make up for that demanning period that we had to go through. I will say that right now, fortunately, that demanning has been recovered, and we are back at the manning levels and structures that we needed per the plan, and hopefully we can now be quite clear on our schedules going forward.
Thank you. That's clear. Another question on break-even prices. Is it reasonable to assume a fairly similar break-even price per barrel in the future as today, or will that be impacted by the reserves declining going forward? The break-even price, I guess, is referred to.
Sure, yeah. So we are in oil and gas. There is a decline curve that sits with every field, but I think one of the things that's spectacular in the DUC and with the reservoirs that we have, our decline rate is clearly less than the average inside of the North Sea. Further, as I've talked about, we have tremendous projects that sit there right in our own backyard. These barrels that are close to infrastructure, we already have visibility to them. They're extremely low risk. And because they're close, because they can utilize our existing infrastructure, because we actually understand the reservoirs through decades, literally, of production in the DUC already, we'll be able to develop those at even lower capital cost, which I think will therefore actually decrease the average capital costs that we've put into the projects. And since these are nearby barrels that will utilize existing infrastructure, just as Tyra is going to do, I think we'll start to see, we should be able to maintain a relatively flat operating cost. Macro world, of course, involved. We have to understand that. But the cheap barrels, along with the ability to access existing infrastructure, should not create a significant increase in our operating cost, just due to that fact, just the fact that they are the barrels in our own backyard tied to our existing infrastructure.
Okay, so when you say relatively flat, that's before Tyra commenced production or including?
Including.
Including, yeah. Okay. Okay, the next question, a pretty straightforward question. Is it true that the reserve life is around 20 years?
Yeah, it's if you took and looked at our reserves where we are now, you would get 20. But obviously with Tyra coming on, we'll be producing reserves a little faster than that. So probably in a more transparent way, the RLI, the reserve life index, is probably around 15, which is actually very healthy. In fact, even then you wonder, can you do something to accelerate the reserves that are in the ground a little bit more beyond that? We're probably at 15 years. If you look at the profile that we have with our sanctioned projects, with the mature projects that we already see in the hopper, that gets you easily to the sort of 15, and then we still have contingent projects beyond that. The list of projects that I can look at inside of our investment hopper is amazingly long, and some of them are very low capital, low reserve addition. But as I said, there's 10 projects that all are looking to be potentially very capital efficient that could easily add another 70 million barrels of resources. And with that opportunity, it's 15 now, maybe it's 15 rolling. There's a long future in here. I think the biggest thing we need to be looking at is, what do we do at the end of the license period, sort of around 2042, and how do we tie into the Danish government's view of trying to continually focus on a 2050 transition inside of their energy mix.
Mm-hmm. So I guess those 20 years is just, if you just take a very rough back of the envelope calculation, it's roughly 30,000 per day now. That's 10 million barrels per year, and you have 209 million barrels 2P reserves, right?
Mm-hmm.
So that will be roughly 20. So I guess that's maybe the background for the question. So right now, that's probably correct to say. With the
makes perfect sense.
Yeah.
Makes perfect sense. We're just, to be transparent and add in Tyra, you get a slightly lower number, but it's still a good number.
Yeah. Sure. And then we also received a few questions while we're being live here. And the first question is regarding, it's maybe a little bit overlapping to somewhat we already discussed, but that's still was the question. It's around free cash flow after Tyra first oil. How much in percent will be distributed to shareholders?
Good crystal ball. What do you think, Ewan? How much are we? distribute to share. I mean, as I've already stated, and you can back on this if you wish, but certainly a distribution of capital to shareholders is part of our intention. That's where we want to be able to get to. We do need to get through and have delivered Tyra and made sure that we've mitigated the risk associated with that investment. And we also want to have an investment hopper. So we'll just need to look at what is a reasonable, if you will, return or distribution to the shareholders on top of additional growth investments that we'll want to make at the time. You anything to add to that?
No, I think that's exactly right. I think when we get to post-Tyra, I think there will certainly be a very sensible conversation around where dividends sit within our structure, and I think it's reasonable to assume that a dividend will be a piece of that. So.
And we also got another question here after we started a live event here. It's what's the dollar break even after Tyra first oil or first gas?
Yeah, you remember that off the top of your head?
I mean, it depends what assumptions you look at, but I think what we've publicly stated is that we expect the OPEX to decrease to roughly $12 a barrel, which is the overall operating cost. And then if you add on some more of the corporate elements, I think you're still sub 20 as a break-even cost, particularly given the tax benefit that we have.
I think that's part of the interesting piece here is if you look at just the operating metric on this, right? And you can take Tyra at $15 development costs and then an operating cost of 12. You can start to see a portfolio that's pushing up towards $30 a barrel. But because of the financial structure and the tax benefits we have, it changes that for us. So it's not easily calculatable necessarily all the time.
Mm-hmm. And there's a third question here. What's the lowest hanging fruit in regards to commence of what's the lowest hanging fruits regards commence of the reserves you have explored, and how far out is it potential production of these?
So the incremental projects.
So I guess this is actually a question regarding the 2C resources. What's the lowest hanging fruits within the 2C resources? Or that's not explicitly mentioned in the questionnaires. And how do you plan to develop these?
So there are, as I said, there's a number of projects that sit inside of that, and some of them from an FID decision to delivery are honestly less than 18 months based on what we see right now. Some of the bigger ones, quite honestly, are still only 2.5 years. So sort of an FID and then a feed and then delivery, 2 to 3 year time frame. These sit around Gorm, they sit around the Dan platform. Some of them are just around optimization inside of the existing fields and hubs in order to be able to access additional reserves. There are some additional wells that we could drill that would tap untapped reservoirs, if you will. Lowest hanging fruit without, I think, since we have an FID, not going to be real specific on those, but there are 3 projects that we're sort of looking at very closely right now that would fit high inside of our barrels in our own backyard or organic hopper. And those, we need to time those out with Tyra investment, obviously. And Total and the North Sea Fund, our partners in the DUC, want to do the same. And so I think it's that conversation between all 3 of us as to when is the optimal time to move forward on those.
Thank you. So it looks like time is running here, and this is actually perfect because it looks like there's no other questions submitted here yet. So David, maybe you would just want to have some final remarks before we round off here.
I think, let me make one comment about us in Denmark, if you will. Denmark, when people think the North Sea, they think the North Sea, and then obviously you've got the very mature, long history of the UK. And actually, from Western Shetlands, which is the younger part, to all the way down and through the UK and into the Netherlands, we're talking extremely mature fields, lots of infrastructure, having to really look at how you're going to commercialize decommissioning activities or extend life of field. That's been sort of the big focus. Then you have Norway, which is really the big new, if you will, investment area. High competition, lots of players, younger infrastructure, more gas, but nonetheless a tremendous place for investment, but a high entry price and high competition. In Denmark, it doesn't have, if I'm really honest, it doesn't have that reserve or resource potential that sits in a Norway, but it has more than enough to create decades of value through production. And the interesting piece there is that being part of the infrastructure, already being a significant player, actually owning a significant chunk of that right now, makes it very advantaged because it's not attracting as much competition, and there's opportunity for the more limited participants, if you will, that are there. And that fits us extremely well when we look at our desire to invest in projects, to have a consistent and predictable set of cash flow, or a predictable cash flow to allow us to invest in a set of new projects. We've certainly and are looking at projects inside of the DUC in Denmark, but we will very much be looking as well to those inorganic opportunities. And that for us is the fun part. It's the North Sea, but it's really different segments of the North Sea, and we will be looking to where we can distinctively and in an advantaged way participate as we grow. We certainly look forward to having investors and our Nordic investors join us in that journey. As I said, you'll find us to be very transparent. You'll find us to be very approachable, and we actually want to listen. So we not only want to have people asking the obvious questions, bringing ideas. We believe in utilizing the bigger brain. There's a lot of people out there, so I hope you'll all join us.
Thank you, David. I think we'll let those words be the final one in this Q&A session. So thank you both you and David, and also thank you to XtraInvestor who has facilitated this Q&A event. And I'm sure you both are happy to take questions through email or other channels for those that are submitting questions that are not be discussed here. So thank you very much for joining, everyone. Also, thank you for all the good questions you have submitted.
Thank you, Theodore, and thanks to XtraInvestor.
Thank you.